Wonderful, wonderful. So, good afternoon, everyone. Thank you so much for joining us today, this Wednesday afternoon, to learn about our very exciting new investment opportunity. My name is Lauren Nieves. I'm the Director of Investor Relations here at Astor Realty Capital. As I said earlier, we're thrilled to present this 49-unit ground-up affordable rental preferred equity investment opportunity. I will let everybody know that we are very, very quickly subscribing on this opportunity. So we're going to take today to dive into the full details to give you guys all the information and make an executive decision. So just a little bit of the highlights of the project. We are projecting very high returns of a net IRR of 16.3 to 18% annual returns with quarterly distributions. This is a very experienced developer. They have over 25 years experience in the industry with $1.5 billion in completed projects to date. We have also got a successful proven partnership with this developer. We have an existing 5-year collaboration with 6 successful investments and exits. And we have a priority position, we have a principal guarantee. So we have those additional factors that make this even more risk adjusted. And the term is 36 months. So highlight of the investment, Joe and our CIO, Andrew, will be diving into it in further detail shortly, but I just want to mention a couple of the market conditions that have occurred over the last few weeks. The S&P 500 fell 3.6%. The NASDAQ dropped 6.34% over the weekend. US job growth has cooled in July with unemployment at nearly 3-year high, but there is a bright spot. Even though there is investment uncertainty, they're out in the market right now. There is significant investments flowing into real estate. For example, Blackstone recently invested $10 billion into 27,385 apartment units, indicating a strong upside for the multifamily sector. So I think that the message here is clear. Smart money is moving into real estate. I will let you guys know that this opportunity is for accredited investors. We will dive into what the definition of that is further, but please do not let accreditation status hold anybody back. Astor Realty Capital, we provide opportunities for all investors. So no concerns there. So before I pass it over, let me tell you a little bit about who Astor Realty Capital is and introduce our speakers, and then we will dive into the details. So Astor, we are an institutionally backed private equity firm. We're led by seasoned professionals with tested market cycle strategies. We invest smart capital into high quality real estate ventures with relatively short durations. We aim to grow and preserve our partners' investments. And we currently participate in a $3.65 million square feet and $2.5 billion portfolio to date. And on that note, I am honored that presenting and diving into the details today is our CEO and founder of Astor, Joe Burko. Joe is a highly esteemed entrepreneur. He has 25 years experience in the real estate. I think actually it's now closer to 30. He has led Astor to the forefront of the industry. We have been producing our investors mid 20% annual returns to date. We have never lost a dollar. As I mentioned, under his leadership, we're participating in 12 major US markets, nearly $4 million in square feet of prime real estate valued at approximately $2.5 billion. Joe has also won awards that have acknowledged his innovative approaches and his experience in the real estate industry, such as Power Broker by CoStar and New York Signature Broker by Globe Street. So he's always very willing to share his knowledge and experience with our investors to not only provide you access to valuable, successful investment opportunities, but to help you become a better investor as well. And also today, we have the honor of Andrew Milbank, who is our CIO at Astor. He will be diving into the opportunity alongside Joe Andrew, brings his extensive knowledge and expertise, ensuring our investment strategies are both sound and profitable. So on that note, guys, I'm going to have you share the details that Joe and Andrew will be diving into. As always, please use the comment section. We will address any FAQs towards the end of the session. We can use your raise hand feature again towards the end of the session. So please, we want this to be interactive. You've got that feature available. Alrighty, so thank you so much. Let's dive in.
Hi, everyone. This is an exciting opportunity, and I am very happy to be able to share with you a deal that I think was structured that really answers a lot of what you, our investors, have been looking for. Security, location, experience, cash flow, distributions, and even interesting tax structure. So without further ado, let's start. Brooklyn, New York. This is our sixth project going on with Joel Schwartz of Southside Units. Essentially, this is a developer that we're very proud of, and we're very proud of the work that we've been doing together over the last 4 or 5 years. We've had multiple exits. We'll spend a good amount of time about our developing partners' experience and discuss in more detail why we feel very comfortable about this project. But let's just dive right in. On the business plan itself, essentially, we are looking into a project that is preferred equity. For those who are not familiar with preferred equity, we're effectively looking into a project that is essentially a ground-up construction where we do not take the risk associated with deviation in a ground-up project. We essentially get ourselves a return that is fixed and that is distributed over the course of the next 3 years. In this particular case, why do we love this project? Well, we love this project because we are accelerating our risk. We're reducing our risk by creating the preferred equity structure, offering you, the investor, a net return. And when I refer to the net, I mean after all of our fees and after all the association fees costing and costs associated with this project, that will range between 16.3 and 18%. How do we create this range? We'll talk about more in details, but we've created 3 different investment options. Those are really referred to the amount of investments. If it's under a certain amount or a middle amount or a larger amount, will determine how much you, the investors, essentially are going to be getting on an annual basis spread out over 4 quarters. Experience is extremely important to us. This developer has been around just shy of 30 years, focused on one asset class and one asset class only, and in one borough of New York City only. The asset class is multifamily, and the borough is Brooklyn. For the last 30 years, nearly 30 years, this developer has created an amazing structure, working with the same number of architects, the same number of GC and contractors and subcontractors, and amassed himself an amazing, really a wonderful portfolio of cash flowing buildings. He nearly never sells. And so, we're very happy to work with him. We'll talk more about those numbers. As I said, the experience also on our side, this is our 6th project doing together, and we're very happy to report that we're seeing multiple exits at this point. It's always, structured very well, and we're able to get terms that we can't get at other ventures. Even in terms of our position, we always look at the deal from the worst standpoint. What does that mean, the worst standpoint? Not just from the standpoint of what it is that the deal is going to do on the best day, but rather what will happen if we'll have to do like a takeover provisions, or if there's some sort of a default situation, we had to take over the deal. We're super happy with our position within what we call the capital stack. In this particular case, it means that we are basically last dollars on a stabilized asset at around a 9.55% yield on cost, or if you will, 63%, including our last dollars as it comes down to uh, overall evaluation of the project. It's a short-term project, 36 months with one 6-month option. And we're getting a personal guarantee. The personal guarantee is extremely important to us. This is a developer, and this is a group that's extremely financially strong. And to get a personal guarantee, it's just ultimately something that we don't normally see in this environment. And we're also doing something that is essentially good for the city of New York, the state of New York. We're working with a specific program that helps families that are in distress, families that are effectively found themselves in all sorts of tough financial situation, locate into a permanent residency, and working through this program. We'll talk more about everything else that's going on. Right now, I'd like to go over to Andrew, our CIO, who's going to talk to you over this particular page and describe the return of the investments. Andrew, to you, please.
Sure. Thank you, Joe. So basically what you're looking at here, right, we are raising up to about 4.657 million of preferred equity for this project. The chart that you see here is a little bit of a, kind of a simplified illustration that I think helps to walk through what those returns look like to you over the next 3 years. So as Joe mentioned, this is a 36-month investment. There is an option for an additional 6 months, but we simplified it down to just the 36 months here. So, keeping it simple at the $100,000 level, if you're investing $100,000, let's say that's August 15th for our example here, you can expect net, right? So as Joe said, net of fees and promote, $2,153 per quarter as a distribution. And then annually, there is a catch-up, so an additional $8,142 at the 12-month anniversary of the investment, right? So just about $16,500 per year, with, again, roughly half of that coming quarterly, and then roughly half of that coming at the annual catch-up. And then right at the very end, right, in this example, August 15th of 2027, you're getting the final distribution plus the return of the net investment. So that gross investment is inclusive of the participation fee and startup costs, right? That's everything on the Astor side for setting up the deal, putting the LLC, the PPM, the legal, asset management, site visits, reporting, taxes, right? All that kind of stuff is inclusive, right? So that fee is to Astor for the it's paid up front, and it's for the duration of the project. So we're returning the net principal of $96,500. So over the course of 36 months, you're looking at total distributions, $146,764, which is a net profit of $46,764, or a net IRR, right, on an annual basis of 16.3%. So you're really getting that benefit of very strong risk-adjusted return. Again, we're in that preferred equity position, so we are outside of the deviations of potential project budget or interest rates or market forces, right? And you have a quarterly cash flow with larger annual bumps along the way. There's some other examples here. We can discuss those with individuals. Basically, we've broken up the classes into 50,000 to 250,000, 250,000 to $1 million, and 1 million plus. And for our many repeat investors that are going to be on this call, that is inclusive of your entire relationship with Astor and any deal that we have done together. So something to keep in mind. And the PPM, which will be available to all investors, goes into the language of all of this a bit more. So please, feel free to reference that. We'll handle any questions. I know that can be a lot, so we'll handle any questions after the presentation here. Moving forward, there's a couple additional points that we wanted to discuss on the legal and structuring side, that above and beyond the preferred equity position that we're in, and above and beyond the personal guarantee that we have, which Joe's going to discuss a little bit more, why we think that is a an even better personal guarantee than you might typically see, right? There's a number of things on the legal and structuring side that we implement in pretty much every deal, and certainly in this one, where Astor has control over major decisions. So we're not sitting there talking with the developer, telling them how to build, what kind of windows to do, anything like that. But anything outside of the approved budget or approved business plan, Astor would need to approve, right? So we have protection there to make sure that the project is going to be, what the developer says the project is going to be at the outset. Okay. We also have takeover provisions in the event that something does go awry. We have very stringent takeover provisions within the agreement that allow us to take over, potentially bring somebody else in to replace it, sell the property, refinance it, right? Anything that we need to do to protect our capital and your capital, right? And I'll skip ahead right to the bottom. When I say our capital, right, alignment of interest, I'm investing in the deal, Joe's investing in the deal, several other employees, family members, friends, etc., are all investing in this deal. All, our money is side by side with yours. So we have a very, very good alignment of interest in this property. Capital call protections, again, if the budget, something, there's been a lot of this over the past several years. If the budget were to go up, we are insulated from that risk. It is on the developer to fill the shortfall there. Okay. We have stringent reporting requirements, right? The developers reporting to us on a monthly basis. We have monthly calls. We're seeing the loan draws, things like that. We have calls with them. We do site visits. So there's a lot going on behind the scenes on the asset management side, where we're bringing that reporting to you. And there's no liability for the loan. So from our side, from your side, the developer is solely responsible for any guarantees on the loan. So a lot of really good, favorable provisions in here that are protecting, our capital, your capital. Joe, we'll hand it back to you to talk a little bit more about the project itself.
Thank you for that, Andrew. Let's talk a little bit about the property itself. So the property is located in Brooklyn, New York. This is going to be a building that will house 49 apartments, a mix between 3-bedroom, 2 bedrooms, and 1 bedrooms. And there's also going to be a 1,500 square feet retail component on the street as well. It's located at 3501 Atlantic Avenue, just several short blocks away from where we've already finished a much larger project with 227 units. What's unique about this area is that it's a very large hub in Brooklyn of plenty of subways and buses and transportation. The area is known as Broadway Junction. And as I said, this is a blue-collar neighborhood, not a very fancy neighborhood, an area where we'll expect to see affordable housing and sort of like a low, medium income. What's happening over there and what's happening in New York in general is that New York has become super expensive. We'll talk more about it in a few short minutes. And here we're actually getting a couple of very important things. First of all, we're getting a 35-year tax abatement. It's called a 421A. It's a program that has completed in the summer or late stage of 2022. And so it's a very, very coveted type of a tax abatement going on for 35 years, where the first 25 of those years, the tax are going to be frozen at the current state. So instead of paying around $360,000 when the project is completed, we're freezing the taxes for just shy of $40,000 per year on taxes for the next 25 years. And the last 10 years, it's going to start phasing out. That is extremely valuable. It's extremely valuable. It's a huge, tremendous savings. Well over $8 million, close to $10 million in saving alone. And we put this into the valuation of the project. We'll talk about it in a couple of moments from here. On top of that, we also have a program called CDFEPS. CDFEPS essentially is a program that designed by the state and the city of New York to allow an affordability for families that have gotten into all sorts of crisis, all sorts of situation, whether it was their apartment that was burned down, whether they had loss of a job or loss of a relative, any of those situations that have dragged families into sort of like a intermediate housing. The city is essentially creating housing for them. We have over around 80,000 units that are in need right now in the city of New York and throughout the state of New York. And this is like a drop in the bucket. And so the demand is extremely strong. The city and state are responsible for the vast majority of the rents. And so we're essentially dealing and getting payment from the city and state of New York. And we're doing fantastic. We're doing a great real estate deal, but we're also helping out families that are in need. And so we're sort of like doing a double whammy here. We're getting paid handsomely, but we're also doing something that is socially responsible, and at the same time mitigating risk, creating value, and so on. In order for us to be able to essentially allow for this program to get our 421A or to get our tax abatement, the asset itself has to be demolished, and we need to have some sort of footing in the ground before a certain date of 2022, which this project qualifies for. And effectively, we are now essentially now a candidate for this particular program. Let's talk a little bit about the timeline. In terms of the timeline itself, we're looking to close this investment and close the raise of this investment right now in the month of August. Our aspiration is to try and close it in the month of August and get this investment rolling. The site has been acquired some time ago. It's gotten the contract at the middle part of 2022. They've closed after they've got the site approved for the 421A that I've mentioned, the tax abatement program, which is extremely valuable. And so we're essentially, the site has been purchased. The plans have been approved by the city and the Department of Buildings. And we are now qualified for, a qualified candidate for the 421A and for the City FEPS program, as I mentioned. Since this is a small building in comparison, 49 units, 30,000 square feet, not a large unit, a little bit over 30,000 square feet, not a very complex structure. We believe that this program will lead us to about the building will take around somewhere in the vicinity of 12 months, maybe 14 months, maybe a little bit than 18 months at a maximum. In order for our investors, in order for ourselves to keep the capital in the deal, because we would love to get those type of returns in a reasonable period of time. In order for us to keep it, we are asking with the developer that once he finished the building, the exit is going to be refinance of the existing construction loan, and will be essentially exiting through that. So the developer essentially is going to be taking us out. We're giving the developer an option to give us another similar property where we will simply roll our equity over to another like kind project. It's not a 1031 exchange, but we will simply roll our equity from one to the next. Many of you here on the Zoom, in fact, have done that with us on previous projects before, and effectively continue the stream of income while we're sitting on another property that is very similar, both in terms of location, in terms of course, asset class, it has to be residential, and so on and so forth. We're expecting this project to take us through 3 years at a maximum with 1 6-month extension. Let's talk a little bit about what is the state of rentals right now in the residential market in New York City. And so it's quite a unique state. While the condo market is sort of like doing okay, not great. Interest rate has certainly affected, the buyer's ability to acquire condominiums and homes and so on. The rental market is on fire. To put it in numbers, vacancy factor in New York, the vacancy factor is 1.4%. It's quite a shocker. We've added this to our presentation. Can take some time and go into it. So 1.4%. This is something that has not been seen for the course of over 58 years, close to 60 years. The type of vacancy, such a low vacancy, have not been seen. What does it really mean? It really means that if you're out there in New York City trying to rent an apartment, you'll find two things. There's no availability of units, and if you'll find one, it's going to be extremely, extremely expensive. And so we're offering something to the residents of New York. We're offering a program that is affordable and we're helping with this situation. As I mentioned earlier, there's about 80,000 candidates that are looking for any form of affordability and affordable units in order to occupy apartments, because it's just a very, very hard situation to be. We have some information here about the neighborhood. I usually skip that part. You can take some time, read about the neighborhood, read about the area. As I mentioned, Brooklyn is a very diverse borough of New York City. And it has various areas. Some of them are super expensive, others are blue collars, and so on, all sorts of deviation in between. Take some time if you're interested, read about the location in length, and educate yourself about this. Let's continue to the financial segment, and I'll move it back to you, Andrew, to talk about the capital stack.
Perfect, thank you. So here you'll see what we call the sources and uses, or capital stack of the project. Sub 70% loan to cost on the senior loan, just about 17.2 million. Astor's preferred equity slice in there, right, 4.5 million. And then the GP, right, Joel, is bringing just under 3.3 million. And as a reminder, I'm not sure if we had touched on this, but that's all Joel's equity, right? So that's not syndicated. That's not, him bringing $50,000 and then bringing a whole bunch from other investors. That's all his equity. He's been the entire equity in the project thus far. So that's another huge commitment, right, that we're seeing from the developer. And it's a great thing to have preferred equity where, there's such a big amount of money from the developer that is subordinated to you. You'll see here the project costs. I'll touch very quickly on this. This is Joel's bread and butter. He's been doing this for 20 plus years now in Brooklyn, exclusively in Brooklyn. 85 something buildings in his portfolio now. He's probably built 125 to 150 at this point at least. So he knows exactly what he's doing. We're very confident in these numbers, as is he. And like Joe said, I mean, he's just a very efficient machine here, where he's doing several of these at a time. So these numbers are tried and true, and we feel very good about them. But at the same time, if there are deviations, right, we are not at risk for that, because we are in the preferred equity position. A little bit about the program itself. Joe's touched on it thus far, but you can see the unit mix here. Average rents, most of the units are 2 and 3 bedrooms. This program is designed for families, the City FEPS program. Basically what this program is folks that have experienced some type of distress, whether it's family, financial, etc. They are now transitioning back to permanent housing, right? So we have here a kind of a program rent explanation on these 2 pages. It can look a little bit confusing. Essentially, the city is helping these tenants pay their rent. Typically, it's on about a 90-10 basis, where the city provides about 90%. The tenants pay the other 10%. Right, this is a very good program for the city. It's getting people back into permanent housing, right? It feels good to do that. But at the same time, we're here to make a return. So this is a very lucrative program as well, where we're achieving very good rents and we're getting a very good yield on the project. Okay, these AMI guidelines, right, area median income, are set for New York City as a whole, right? So it doesn't have to do with a specific borough that you're in or a specific neighborhood. It's New York City as a whole, and it's set by the federal government. Okay, so this is an as of right program, meaning that there's nothing special permit wise or exceptions to the rule that need to happen. This is just, we're able to build 30 something thousand square feet, 49 units, and we're in this program. Okay, talking with the developer, they estimate, and talking with the city, there's roughly 80,000 people right now that are looking to obtain housing like this, right? There's 80,000 people that are in the system that are looking to get into a program like this. So, really big demand there for this. And we've kind of got a very nice niche in this neighborhood, where you see this previous project, 2700 Atlantic, that we did with the developer, right, just a couple blocks down. And he's got several others right in this immediate area that he has been, identifying them, building the sites, and bringing the partnership with the city for this program. So very, very big demand for that. We're filling that need. It feels good, but there's also good financials behind it. You'll see here the pro forma. Most of the rent here is from the residential side, right? That's what we like to see. That's where the real demand is. Very small retail component, which will, serve the tenants in the building and also kind of just enhance the overall area. I'll touch again briefly on that 421A, right? So you'll see documents in the due diligence file, which Laura will share with everybody. A huge benefit to the project. The developer was able to put footings in the ground, put a little bit of a slab. We have all of that documented. That was done in June of 2022, just prior to the 421A's, the previous version of the 421A's expiration. It is a tremendous value add to the project, really increases the cash flow. And it's something that any potential future buyer, if the developer were ever to sell, is able to take that value as well. So it really adds to the value of the project. And there's a newer version of the 421A, not nearly as good as this one. So again, that's just a tremendous bonus for the project. And really, I think that's one of the things that we love about Joel. He's always identifying projects like this. He's identifying great ways to make cash flow. So Joe, I'll turn it really quick back to you here. Talk a little bit more about Joel, our successful partnership with him, and I think certainly want to touch on that personal guarantee and why we think that's such a tremendous value for our investors here.
So experience just means the world to us. It's not the only factor we're looking for, but it's certainly one of the heavy stones that we weigh before we go into every project. In this case, not just the experience of our operating partner, but also the experience that we've had with our operating partner over the course of the last 5 deals, now going into the 6th. So Southside Units, to talk a little bit about their history, started over 25 years ago, and again, close to 30 years. And, it's a very low-key group that focuses only on some of the better neighborhoods around Brooklyn, between Williamsburg and Greenpoint and other locations throughout Brooklyn. And lately, in the last several years, have started going more and more into the blue-collar neighborhoods to build over there as well. As I mentioned earlier, the focus is almost laser into one segment of real estate, the multifamily rental segment. And that's the only thing they build. So since it's very hard to find, sizable deals, their style has always been pick up small to mid-size apartment buildings, anywhere from 25 to 50 units, typically build them quick, do a good job, maximize rents, work with whatever is possible. If there's a tax abatement program, use that, but otherwise buy, create a massive cash flow. To date, they are now holding around $1.45 billion of real estate valued as of now. They've amassed 1,890 rental apartments plus retail in some of the base of those buildings, creating themselves into one of the largest and certainly the most active development and holding company within Brooklyn. There's a group that has close to 90 buildings and a tremendous cash flow. And so with everything else that's going on, we're looking into a group that is highly focused, highly effective, and we just love to work with them. We have negotiated, among other things, above the fact that we have a preferred equity position, that we're accelerating ourselves. We were able to negotiate things that we typically don't have within the scope of preferred equity positions or investments in real estate in general. And that is to get a personal guarantee. I'd like to spend a couple of moments on it because I feel it's extremely important. That personal guarantee is sort of like a backstop that if the worst of the worst should ever happen, And we would take over, we being Astor, you guys, us, take over the project, which we have all the language for on the legal side of things. If we were to step in and sell the asset or force a sale of the asset and still not recoup our investment amount, we have a personal guarantee to go after by the owner of the company. What does it really mean? What's the value of the owner of the company? So let's go back. We have a group that is owned by a single individual. That individual has amassed a portfolio of $1,450,000,000. And once we looked at his financials, we started pulling aside the bank notes, right? Pulling aside all sorts of partnerships that are outside of this particular individual. And we are left with around $350,000,000 that is directly associated with the ownership of the developing partners of ours, Mr. Joel Schwartz. And so this portfolio also creates a massive, massive cash flow. On an annual basis, we're looking at $30,000,000 free cash. That is after you pay all expenses, pay the mortgages and all the debt service. You're left with around $30,000,000. Once we bifurcate again, all the partnerships outside capital that does not belong to Mr. Schwartz, we're essentially looking at around $17,000,000 net cash flow. Creates about $1.4 million of free cash flowing from all the rents of over close to 1,900 apartments flowing into their organization. Based on that, we were able to create effectively a program where we are able to take quarterly payments while the building is being built and is not generating income. And so we've had some of the questions, how are you able to spread income when you're building a building and there's no income in it? Well, the income is actually coming from the the other 80 some odd buildings that they have under their portfolio that is cash flowing. I think at this point we'll stop here. We'll cover a little bit about Astor Realty Capital for those who are new or maybe less familiar with our organization. And so Astor Realty Capital is a firm that I've started some now 8 years ago. I've been in the real estate arena for now close to 30 years, 29 years, since 1995. We have effectively invested in properties across 7 states and 12 major markets in our portfolio that amasses from inception close to 4 million square feet and is marked to market at valuation of around $2.6 billion. You can find apartment buildings, condo projects, hotels, logistical centers, mixed-use projects. We do invest across the capital stack. And that really means that sometimes we'll offer you, our investors, opportunities to invest in cash flowing deals, such as this one, preferred equity positions. Others, opportunities will be first position debt, and other opportunities will be simply coming in and taking a stake in the deal and building a project together as partners together with the developers on equal footing or shoulder to shoulder, pure equity deals. What's important to us is preservation of capital, and to make sure that we have strong control rights in every project. We look at over 700 projects a year. We really say no to about 98% of them, and we close around about 1% of those deals, anywhere from 6, 7, 8 deals a year. Alignment of interest was spoken about before. I think it's extremely important. My capital, the capital of the other executives in the firm, is in every deal, takes the exact same risk as everybody else. So is the capital of my kids, so is the capital of my wife and our family members and their friends, so on and so on. We're very big on asset management. It is something that we spend a lot of time on and we take a lot of pride in. And so you'll never have us as a passive As a passive group, we're always very, very active. While we're not the developers, we don't make the decisions as to what sort of color of tiles we're going to use and what kind of windows we're going to be buying. We are very focused on the business plan that we've agreed to from the very inception of whichever project it is. And we make sure that we monitor each and every one of our investments and we report to you. Very big on the reporting. And I think that, with all the information that we collect and the experience, which is on a collective level, on the experience level of our executives is now 65 years, my 30 years plus the additional individuals that are with us, have 65 years of experience within the real estate arena. In our presentation, you can also take a look at some of the projects that we have. We also share with our investors mark-to-market reports on a quarterly basis where we sort of like see where things are staying from inception. As I mentioned, we're over 4 million square feet, over $2.6 billion. And I think we have a nice track record, and I'm happy to report with everything that was going on in the world, from pandemics to inflation to various other issues that we were going through in the last several years, like everybody else. We have no losses, no loss of capital in any of our projects, and our return on average is above 20% overall. This brings us to the end of the presentation. I just want to say a couple of more words before we'll sum up. This is a unique deal. Preferred equity positions typically don't pay as high. We were able to negotiate this based on a number of factors. A, we're very, very exclusive as to which projects we're going to invest in. B, we have deep relationships with the partners that we are building with and creating those beautiful portfolios and large properties. But this is also a sign of the times. It's not just us. Interest rate is high. We're able to drive and we're able to offer you, our investors. Investors have been with us for the last 6, 7, 8 years on multiple projects, much higher returns than you will find anywhere in this market, and adjusted, very well adjusted for the risk that we're all taking in every project. Every project does take a risk. There's no such thing as no risks. Having said all of that, I think that with the personal guarantee, with the high returns, with the distributions that is happening, and with the track record that we have with this developing group, and this developing group has over the last 25 plus years, close to 30 years, I think we have a very unique project. I hope to find a lot of you coming back and joining us in this project. I truly hope to have a lot of new investors joining us in this project. Thank you all, and good luck to us.
Wonderful. Okay. So we will open up the floor again for some live Q&A. Andrew, as you're aware, there's been a couple of questions that we can start off with that have been dropped off in the chat.
Yes, let me go through the couple that I see here. So Sarah raised a question. There's an article online. A lender had filed for foreclosure against Joel. We are aware of this. That was back in, I believe, November of 2023. We did address this with Joel at the time. He is in the process of actually refinancing that. The closing is scheduled as of now for the end of this month. Basically, the story behind that, it's actually a hotel asset on Bogart Avenue in Brooklyn. He has a loan right now from Avana Capital. That loan was for the construction, and it was supposed to convert to a permanent loan. Right, that's something that lenders would typically do, offer some sort of bridge or construction loan that converts to a lower rate permanent facility. Avana did not do that. They kind of changed the terms of the deal. They cited market conditions, and then they tried to foreclose on him. He's negotiated with them at this point and now has the refinance lined up. So it's not something that we are concerned of at this time. And he's been upfront with us about it, and he's been good to explain it. We actually have a letter in the due diligence file regarding this as well. So any other questions, I'm not happy to answer, or happy to get more information from Joel on the property for anyone. I see a question from Kevin here. How does the senior loan affect our ability to recover in a worst case scenario? I also, it's kind of paired. Sarah, you had another question on worst case scenario if we need to take advantage of the personal guarantee. So basically, what the personal guarantee means is that in the event that we are unable to recover our principal via a sale of the asset, right? So let's say worst case scenario, the project goes sideways and right, something's happening. We can try to sell the property, right? We can try to bring in a different developer to finish it, right? Realize the value. And in that case, if we foreclosed on it, right, there's actually excess value there potentially, right? We have Joel's equity behind us as well, plus the value of the completed building. So that's an option, right? We could refinance it, we could sell it. The personal guarantee is there if we don't recover every single dollar of our principal. So legal fees would be on top of that. So, $4.5 million would be 4.51 million, right? At 100,000 or something for legal, just to pick a round number. And I see Kevin, right? So kind of tying into that on the senior loan, right? How is that affecting our ability to recover? So because of the takeover provisions that we have, right, our relationships with other lenders in the marketplace, right, we would be able to bring in someone to refinance them, right? Especially if we're bringing in another developer to finish the project, right? That would be something that using our strength and theirs to refinance it. And Joel himself, right, has plenty of relationships, and we kind of just touched on it with Bogart Avenue, where a lender was playing games, right, according to him, changed their terms, did not honor the agreement that they had, and he's now bringing in another lender to refinance them and remove that issue from the situation so that the property can continue. So hopefully that answers that. If it didn't, we can do the raise hand or just drop another question, and I can try to expand on that more.
Thank you, Andrew. I will. What a fantastic session, and so many questions answered from everyone. I do want to just take a 2-minute opportunity, as we are now over an hour into this, just to let everybody know that again, our let me just make myself, there we go. I will let everybody know that the minimum investment into this investment opportunity is $50,000. Of course, we are always a little bit flexible with that for any new investor and any investor. Really, we want everybody to feel comfortable with where they're placing their capital. We are looking for a closing towards middle to end of August. So this is a quick one. There will not be a huge amount of downtime. So, investment documents will be ready in the morning. I have been sharing in the comments the link to our portal that you will be able to find the full investment memorandum, the link to our due diligence files that both Joe and Andrew mentioned quite a couple of times. Tomorrow morning, I'll put up this recording. Our full subscription to documentation will be available and ready to go. As I mentioned first thing earlier today, this opportunity is available for accredited investors only. If you are unsure what that means, please contact me and I will let you know. But typically is based on your net worth or your income levels. We unfortunately do have to abide by this. It's a 506c investment. We file all of our investments with the SEC, so we do have to meet their requirements. So accredited investors, if you do not fall into that category, don't fret. We have other opportunities to discuss with you. So I just wanted to highlight those points, as we are getting over an hour and we have more questions coming in. So I'll let Andrew answer that. If anybody has any questions in regards to how to proceed forward, anyone who sent me a commitment, I'm logging it. I've got it. I will action it probably first thing tomorrow morning at this stage. Okay, back to you, Andrew.
I typed answers. I don't know if Kevin or Aaron, if you have additional follow-ups on that, happy to answer them. I see Aaron asked about the tax consequences. I'm very good with real estate and real estate analysis. I will never pretend to be a tax advisor. So Aaron, I dropped mine and Laura's emails in there. I'm sure you already have Laura's, but we're happy to run any questions by the appropriate tax person to make sure that we're addressing that and it's answered correctly.
Wonderful, wonderful. And Andrew, you answered Sarah's question about the taking advantage of the personal guarantee, how that what that looks
Yes.
like. We do have to.
Yeah, I hope so.
I thought so. I apologize. Wonderful. Okay, beautiful. So last opportunity again to drop any questions in. Minimum investment $50,000. Thank you to all those that are committed already. And we're filling very, very fast, everyone. So please let me know. You know, Andrew, Joe, they are more than Marika. They're more than happy to walk you through, answer any questions one-on-one for you to make a decision. I am, as we had a few questions come in from investors pre-webinar. So I am going to play, as long as my technology works well, I am going to play one more short recording. But and anyone who obviously wants to again hang around after and get some one-on-one questions answered, we absolutely will. So about got another 5 or 6 minutes of pre-recorded questions, but if we lose anyone during that, thank you so much for joining us, everyone. It's been a pleasure.
Sure. So there's a number of provisions that we have to protect in the event of default. One is that we have takeover provisions. So if something goes wrong where the developer defaults on the senior loan, we're able to try to step in and cure that, try to take over the project, sell the project, refinance, or even just continue building it ourselves. Bring in a new developer to do that. We also have the personal guarantee from the developer, right? What that means is that if all of those fail, we're still able to go after him personally to reimburse our principal in the project. So we have a number of things that are protecting in the event of default to make sure that we have the preservation of capital. If and when the developer brings a rollover opportunity, it does need to be a similar project, right? So the subject one, 3051 Atlantic Avenue, is a 49-unit apartment rental development that is a shovel-ready site in Brooklyn. So the next project that he brings would need to be roughly 50 units. It would need to be in Brooklyn. It needs to be an apartment building, and it needs to be a rental project, right? He can't bring us a hotel. He can't bring us a retail shopping center in Queens, right? It can't be a project that is going to have a 10-year timeline, anything like that, right? It needs to be a shorter duration, ready to build site that is a rental building in Brooklyn. And it also needs to satisfy Astor's underwriting criteria. Okay, so it has to have a sufficient yield to cost. The leverage needs to be correct, right? We need to understand and feel good about the project and the potential risk of the project. I will say too, as an example, on a previous rollover structure that we've done with the developer, he brought us a project that we declined, and we told him to bring us a new one, which he did, which was actually one that you'll see in the presentation, 310 North 7th Street in Williamsburg. That was actually the second project that he brought us because we declined the prior one for the leverage point, and we weren't entirely satisfied with the yield to cost of that project. So we do have the ability to decline projects. And if we decline, to the point it's like, hey, you sent us 3 projects now, he can always pay us back the principal and any outstanding interest that's due, and we can move on to another investment. But obviously, it's our goal and his goal for this, for this money to stay outstanding for a longer period of time. Right. So we're looking to close this in August. So funding is really, within the next couple of weeks here. We're looking for, I would say within the next week, we are looking for kind of a yes, no decision. And within the next 2 weeks or so, we are looking for funding. This is not a typical Astor project where we have a longer timeline. We're looking to make this happen in August. The project itself is a 36-month total project with a 6-month potential extension. The specific one that we're starting with, 3051 Atlantic, right, is roughly 12 to 14 months of development with about a 3 to 6 month ramp up period to stabilization. Again, we expect that to be very quick. There's an 80,000 tenant backlog of demand for this project, or for this type of program here with these rents. So we do expect that to fill up very quickly, at which point the developer would refinance and roll us to another project. I do also want to note too that, given that it's a 36-month term, 42 months in total, the developer is not allowed to bring us a project in month 33, right? Pick a random number and say, okay, great, here's your new project in month 33. That's not going to be enough time for him to reasonably develop a new project and stabilize it, that he would be able to take our capital out in a reasonable circumstance, right? So there is a limit on when the last rollover could be. So he's really only allowed to roll over the capital twice. And, the second one would have to be within that 25 to 30 month period reasonably, where we'd say, okay, there's going to be no stress to him or to us to take out this capital. So I just did want to mention that as well. Yeah, so you receive a K1 annually. That is something that we've looked at very carefully with this particular investment. It is not final yet. We will still take some advice from our tax advisors. But what we are planning to do is treat this as long-term capital gains. So basically, the quarterly and annual catch-up payments will all be treated as return of principal for K1 purposes, with the final payment at the end being treated as long-term capital gains. That would be for majority of investors in the U.S., right? U.S.-based investors. For international investors, we may have a separate tax structure to be determined. But for all of our U.S.-based investors, it would be return of principal on the initial K1s, which you receive annually, and then a long-term capital gain at the end, because that is the most favorable tax structure that we found that most folks enjoy. This does not affect the distributions though. So, an example, you invest $100,000, just because your K1 shows, $10,000 return of principal, that does not affect your distribution the next year, right? Your investment is still based on your initial invested amount, and the PPM is very clear to state that. So I didn't want anyone to worry that would be, giving you a lower return in future years because of the way that we're doing the tax treatment. Yeah, so 1031s are not allowed. That's not something that is a like-kind exchange, going from whatever that previous investment would be to this. So unfortunately, 1031s are not allowed. IRAs, Roth IRAs are highly encouraged. We have tons of investors, I don't know the number, that invest through an IRA. It's a very favorable structure. Laura can potentially spend a couple more minutes on that, but I know we have a lot of resources available for that, and we have a number of investors that invest through IRAs. We're very familiar with the process and the paperwork, and I think we have a lot of satisfied folks that are able to utilize that, because it's a great alternative to the kind of very limited universe of investments that you typically have with regards to an IRA, where you're really only able to invest in the stock market. So certainly it's allowed, and it's really encouraged. And we have a couple employees actually that use their IRA to invest.
Okay, fantastic. I am going to call on MP Aluko. MP, thank you so much for your patience. I know it's been a second. You are able to unmute yourself and speak live. Hello, how are you?
Hi, good evening. Thank you, Laura, for having me here.
Pleasure.
And
Thank you for joining us.
thank you, Andrew, for your outstanding explanation about the project. Very well said. Literally, my question has already been answered in a way, but I would like to have more about when I asked about the minimum investment, and somebody responded that minimum is 50K. Right, that's fine. Number one, though. But for the international investors coming in to invest in the US, what are the criteria for them, please?
Let me tell you, MP, how it works. So welcome to
Thank
our
you.
international group of investors. There is many of you here, and we love that we have expanded outside of the United States. The minimum investment, as mentioned to you, is $50,000. Although we say that, we want to be flexible. As a new investor, we are happy to go a little bit lower. We want you to be comfortable. It's important to us that you feel comfortable where you're placing your capital. So that number is flexible. As an international investor, you have one of the blessings that you do not have to meet the accreditation requirements. So the net worth and the income that an accredited investor has to meet here in the US, that does not apply to you, MP, as an international investor. So you do not have limitations there. Now, as I'm sure you are aware, we do highly recommend that you consult with your tax advisor, who is familiar with US structures, just to ensure that you're aware of everything that is involved as to what tax you have to meet when you are an international investor, whether or not that is a higher withholding, which is very common, something that you will get back when you do your tax returns, but either higher withholding, or perhaps, you will fall into we can put you into the interest only structure for international investors, but we do recommend that you are aware of what tax implementations are involved as a foreign investor.
Okay, then. Right. Thank you very much, Laura. As time goes on, definitely we'll build a very good relationship, and then other things and other questions crops up and all that. And then please do send me updates about the project and everything, so I can be able to market you and market the project, not just in the United Kingdom, but globally within my network.
We will absolutely be in touch. We'll definitely, we'll include Joe. We'll have a personal conversation. We love the Joseph group. So thank you, MP.
Joe is a fantastic guy. He is a fantastic guy.
Absolutely. Thank you so much, MP. Appreciate it. We'll speak soon.
All right. Thank you.
Wonderful. So before we wrap up, I'll just do a final opportunity, but I think that we have covered everything here. We truly hope that you are as excited as we are about this opportunity. We truly believe that this is a fantastic investment in today's economy. Andrew, Joe have worked so hard on vetting the opportunity that everything is there in our due diligence files available for you guys. And as I always say, we're more than happy to give anyone a one-on-one conversation to help you with your final decision. So investment details are in the comments. You can go to our investor portal, see the full OM. Documents will be available tomorrow. Due diligence files are there. Anything that you need, you all have my information. I'm available for you, as is Joe, Andrew, and Marika. And on behalf of the team, all I can say is thank you so much for giving us your time today. It's been an absolute pleasure. We look forward to having you join us in this or the next opportunity. Thank you so much.
Thank you.